The 4% rule is a common starting point for retirement planning. Most financial advisors use it, and so do many people who manage their own investments. If you're counting on your portfolio to support you in retirement, you've probably asked the same question: does the 4% rule still work? The answer? It depends on who you ask and what research paper you look at. The 4% rule came from a study done in 1994 that looked at historical market data. The conclusion was simple. If you had a balanced mix of stocks and bonds, you could withdraw 4% of your portfolio each year to make your money last through a 30-year retirement without running out of money. This was a big deal because one of the biggest fears that retirees face is running out of money. That's why this rule became the go-to guideline for retirement planning ever since. Now, Morningstar recently shocked the retirement world by suggesting that the safe withdrawal rate should be just 3.3%. A 3.3% initial withdrawal is about a 17% cut in income compared to 4%. This made the headlines, obviously. If you dig into the paper, you'll notice that Morningstar reached this conclusion using an 8% average for stocks and 2.7% for fixed income. The paper also included an inflation rate of 2.21%. So if the stock market has historically returned 11% per year, you might wonder, why did Morningstar use such a conservative number in their projections? The reason, according to their research team, is that today's market conditions look very different than the years past, and not in a good way. They argue about two things: high stock valuations and low bond yields. When you look at the current price-to-earning ratio of the market, it is alarmingly close to the highs that we saw during the dot-com bubble in 2000. At the same time, interest rates and therefore bond yields have been declining steadily since the early 1980s. Morningstar's paper points out that we're now in an environment with the highest equity valuations and the lowest bond yields in 140 years of recorded financial data, both happening at the same time. That combination is rare and troubling because stock valuations and bond yields tend to revert to their long-term averages over time. That means that stock prices could come down eventually and interest rates could rise again. In short, the paper is warning that future portfolio returns are likely to be lower than what investors have gotten used to in the recent decades. Here's how I see it. When the original study behind the 4% rule was done, it included all sorts of market ups and downs: wars, recessions, the Great Depression, oil shock, and pretty much every crisis that you can think of. And even with all that baked into the data, the 4% rule still had a very high success rate. And that is why it became known as the safe withdrawal rate in the first place. Now, I get where this research is coming from, and I don't completely disagree, but I don't fully agree either. Yes, today's market conditions are different. PE ratios are high right now, and they have been elevated for a few years now. And people have been saying that the market will eventually correct, and they've been saying this for decades. And, it doesn't hurt to be a little cautious, especially when you're seeing valuations this stretched. Vanguard did a similar research on the safe withdrawal rate in 2022. They projected fairly modest returns for the next decade and emphasized that the withdrawal rates should be personalized. For someone who does not plan on leaving an inheritance and just wants to enjoy their retirement spending, a rate of up to 3.7% could work. But for someone more conservative or hoping to leave money behind, that rate might drop to just 2 to 3% or even 1% in extreme cases. What they argue is that if, for example, you're okay with a 90% chance of success, you can probably withdraw more than someone who's aiming for maybe a 99% certainty. It really comes down to your personal comfort level with risk and flexibility. Now, other than these big corporations doing their research, we have to admit that the 4% rule has its limitations. There are a few limitations that we can all agree on. The 4% rule assumes a 30-year retirement, so if you retire earlier or expect to live longer than 30 years post-retirement, the 4% rule may break down. So, for example, someone retiring in their early 50s might need their portfolio to last 40 plus years. A lower rate, like 3 to 3.5%, is probably more appropriate for high success odds. So, younger retirees or financial independents retire early crowd often target for a lower withdrawal rate as a safe bet. In general, the longer the time spent, the lower the initial rate should be. Second, sequence of returns risk is very real. I've mentioned this article from Schwab before. They show a powerful example using two investors who each start retirement with $1 million and withdraw $50,000 in the first year. And they both experience 15% market drops, but at different times. Investor 1 sees that drop early in retirement, while Investor 2 sees it later. The results are striking. Investor 1 is completely out of money by year 18. The takeaway is that the market declines early in retirement can do far more damage than your withdrawal rate alone. Okay, so we've established that the 4% rule still kind of works. There are some limitations, and of course depends on who you ask and what research you look at, but it mostly works. But let's talk about beyond the 4% rule. What are some other approaches to safe withdrawal rate? One approach was introduced by Jonathan Guyton and William Klinger in 2006. They added decision rules or guardrails around withdrawal rates. The idea is that you set an initial withdrawal rate, which can be as high as 4%, and then you have these rules that tell you when to cut back and when to give yourself a raise. So, for example, in this method, if your portfolio is doing well, you can withdraw more and vice versa. What's impressive is that using these adaptive rules, Guyton and Klinger found that you could have started with an initial withdrawal rate of between 5 and 5.5% and still not run out of money over 30 years, at least in historical simulations. Essentially, by being willing to trim spending in bad times and occasionally increase them in good times, retirees earn themselves a higher initial income. The research showed a 65% stocks and 35% bond portfolio could sustain between 5.2 and 5.6% initial withdrawals with a 99% success rate over 40 years following the guardrail adjustments. A similar concept comes from Vanguard, who devised a dynamic spending strategy with a ceiling and a floor on the changes. You decide upfront the maximum that you'll allow your spending to increase or decrease year over year. So, for example, one might set a rule to never increase annual spending by more than 5% or decrease it by more than 1.5%, regardless of what the market is doing. Finally, the 4% rule was created using historical backtesting. It uses real market data to test what has actually happened in the past. So it is limited to the past. It does not account for economic conditions that we haven't seen yet. That's where the Monte Carlo simulation comes in, where the software basically simulates thousands of possible market scenarios, including the ones we've never seen before. Instead of just replaying history, Monte Carlo model randomizes investment returns within realistic bounds to test how a portfolio might perform under a wide range of conditions. For example, Vanguard's Monte Carlo model used in their advisor tool runs 10,000 different simulations for each portfolio scenario, and they estimate a 3.5% to 4% withdrawal rate has around an 85% to 90% rate of success over 30 years, obviously assuming a moderate risk tolerance and a 60-40 portfolio. Fidelity and Morningstar have done similar researches, but the takeaway here is that historical backtesting shows what has worked in the past, but Monte Carlo simulation models what might work under a different condition or future outcomes. That's why many modern advisors prefer Monte Carlo. So back to the question, does the 4% rule still work? For a general US investor today, I would say the 4% rule mostly works as a guideline. But don't forget that the 4% rule was never a promise. It was always a probability-based formula, and it's still a valuable one. If nothing else, knowing that the 4% rule was historically safe should give retirees some confidence that their money can last if managed prudently.